Okay, it looks like we are now live. Perfect. Let me double check that everything is working. All right, looks like we are good. All right, so today what I wanted to go over was everything involving bonds. I thought bonds were fairly basic because I've been in school for finance for so long, but what I realized while talking to a lot of people is that people don't actually know that much about bonds. So today we're going to be going over some of the basics, but then build from there into some of the intricacies. Do pardon my very plain background and white shirt. I got kind of sick of the jacket, so alas, here we are. But two as well. Am getting some decorations for back here and some soundproofing soon, so we'll see how that goes. So I have some questions here. I'm just gonna rip through. If you guys have any sort of questions along the way, definitely feel free to let me know. So first thing is, what is a bond and how does it work exactly? Oh, I forgot. We should actually turn the lights on. Anyway, the lighting's all right. We love natural sunlight. So a bond, how exactly it works? The standard measurement is $1,000. So you take $1,000, you give it to somebody. Usually, this is the government, meaning the United States government has treasury bonds, bills, notes. That's the most common. Or it's for corporations like Apple or Microsoft where they want debt, which they get at a lower rate, then they can invest somewhere else at a higher rate, meaning they can make more money. That's kind of the idea. It's the same thing with the government as well. So what you're getting is a set interest rate and then your money back at the end of a certain period. Typically, there are short-term measures that help with just like cash flow availability. This is like anything under a year, whereas typically more longer-term stuff, 5 years, 10 years, or 30 years. There are some weird ones that are like 50 or 100, and you're like, dude, you're not even going to be alive. Is this company going to be around? Like, this is a little weird, but nonetheless, they do exist. um, so, second thing here is how do bonds differ from stocks? So, bonds are debt, stocks are ownership. When you own stocks, you own a piece of the company and a part of the profits you will get. With a bond, you don't get that. If the company has profits, that's theirs to keep. The only thing you're getting is an interest rate and your money back at some point. That can make it so that you have a lot more predictability, but there's a lot less upside. What are the key components of a bond? So, first piece is the face value or par value, meaning what is the amount of the bond? As we said, typically about $1,000. Sometimes they can be different amounts, but that's usually the set amount. Then you have the coupon or the interest rate. So there's two different interest rates involved. There's the one on the bond piece of paper. They usually don't come in actual pieces of paper anymore, but basically there's a set interest rate when it first goes out. Let's say it's 5%. If the bond is sold and interest rates are currently higher than that, the bond will be sold at a discount in order to cover the difference. Meaning someone doesn't want a bond at 5% if they can go down the street and get one at 7%, so they're only going to offer a little bit of money comparatively. It can go the other way as well. If interest rates flip and you have a much higher interest rate you're offering compared to what the market is, people will pay you extra. Common example, like if you had 5% interest rate and interest rates are like 4%, maybe someone offers you $1,100 instead of $1,000. Now, the actual market interest rate is usually like what is the going interest rate for a company with this type of credit profile. Someone like Apple, they're probably going to pay their debts because they are a $1 trillion company. Whereas mom and dad's pop shop sandwich shop down the street that when they're out of business for 6 months because of the disease that shall not be named taking over the world for a couple years, then all of a sudden that's a lot scarier to lend your money to because they might not actually be able to pay it back if something bad happens. These are different credit profiles. Big businesses sometimes don't make good decisions even when they are big. So there are some big businesses that don't have the best credit profiles and they have to pay higher interest rates and they're riskier in general. Sometimes this is around fast technology. Like, for example, while something like Amazon or Facebook is huge now, when they first came out, they weren't. So they had higher credit rates on things and their interest rates would have been higher to make them in par with that. Which kind of leads into the next question of how do bond ratings impact investment decisions? Personally, I don't really incorporate it into things. So there are these credit rating agencies. What they do, they go through, they look at a company, and instead of you having to figure out what should the interest rate be for this company, these credit rating agencies, they will rate it for you. So there's things like A, B, C, D. Pretty much anything, I think it's B minus or lower is usually not considered investment grade. You get into things called like high yield or junk bonds. You don't see a ton of that outside of like specific mutual funds. So I wouldn't worry too much about that just in terms of trying to understand it. But that ends up making an impact on whether you feel like it's safe to put your money there and how much interest rate you are going to demand relative to other companies, especially like the government, who's usually considered like immaculate. Some governments aren't, meaning, what's happening in a country with 500,000 people versus one that has a billion people, they're different economics. What's the difference between government, municipal, and corporate bonds? So government's usually like the federal government. Then you have municipal, which is more like local stuff, which is the state or like the city. For example, I live in Phoenix, Arizona, so like I could get an Arizona bond or I could get like a City of Phoenix bond. They're usually riskier, but there's usually better tax benefits. The federal government ones, it's like you're not paying the state income taxes, whereas with like the local ones, you're not paying the federal income taxes. Federal income taxes are usually much higher, so it's usually a bigger benefit. Then there's corporate bonds where you just pay the full tax rate, there's no sort of benefits, and that's just any company. What's the difference between fixed rate and floating rate? So usually most are fixed rate, meaning when you first buy the bond, there's an interest rate and that's how much you're getting paid every single set period. Usually the period's every 6 months. No clue why. I've always found that confusing, why it wasn't annually, but it just is what it is. Then there are floating rate ones. These are usually different measures, but as the interest rates change in the market, your interest rate will change as well. As part of that, what ends up happening is you usually can get a better rate initially if you're willing to let it fluctuate because it protects the bank. I mean, the bank doesn't want to be stuck with a note paying 9% to you if you end up, having interest rates go way down and they're paying you too much. It's a whole thing. Okay. How do inflation protected bonds like TIPS work? These got really popular as interest rates went up and inflation was up. Usually there are stipulations around how much you can have, and two, there's also stipulations as far as like prices are usually baked in to certain things, meaning when you're investing, a lot of times you're trying to anticipate changes differently than the marketplace. Tips can help with some of the inflation adjustment, but they're not perfect. What are junk bonds and why do they carry higher risk? We've kind of touched on some of these are kind of hard to cover without accidentally covering other ones. But some of it is basically you have companies that don't have as much security, haven't been around as long, they don't have as big a cash reserves, they don't have as many assets to sell off. They have higher interest rates they need to pay out in order to get access to more capital. Capital meaning big old pile of money. Pardon me. I just finished recording a whole bunch of shorts and now my voice is a little messed up. Anyway, the companies that require higher interest rates, a lot of times if their credit rating isn't as high, then we would call those junk bonds. There was this guy named Michael Milken in the 1980s who became like the king of junk bonds. That was a whole mess of illegalness. That's the problem with junk bonds. They got a really bad reputation in the 1980s, even though a lot of times, like, what counts as a junk bond are perfectly decent companies. They just aren't, like, multinational conglomerates. So, I would take the term junk bond with a grain of salt, meaning there are still perfectly decent companies sometimes. And if you have someone who is professionally managing them, sometimes if you're looking for an alternative to stocks, sometimes a high yield junk bond as part of your portfolio can help diversify a little bit, and they do correlate heavier with stocks than other bonds, but it is something to consider. Let's see. Yeah, it's not really relevant. What is the difference between current yield and yield to maturity? I don't even remember that off the top of my head. There's so many of these equations involving bonds where it's like having it stored in your noggin outside of tests. It can be helpful if you're trying to just like have an intelligent conversation, but like relevantly making investment decisions, I find a lot of times it's better to just relook up the information, know where it is correct, then use the information correctly. And a lot of times I understand it. It's just if I'm tired when I'm making a decision, I'd much rather just verify it the first time. So I guess one thing I can do, a lot of these questions end up kind of going over a lot of the same stuff. Where exactly do bonds fit in a portfolio, I think is an important one. Bonds haven't done as well over the past couple decades. They used to be absolute staples of portfolios, and a lot of the times when you look at like these long charts drawn out from like the 1940s or 50s up through now, and you take a stock portfolio and compare it to a bond portfolio, and you track like how do these measure one versus the other, then you see that bonds on real terms, in terms of like returns relative to inflation, have performed worse than stocks, generally speaking, even like risk adjusted, and they have done worse over time. Some of this has to do with like there's just so much more capital available than there used to be. So giving money to like Apple or Amazon, like no one's scared they're gonna default. Like so instead of getting 3% with the government, you get 3.1%. It's like, what's the point? And when you look at something like bonds compared to something like cash, a lot of times there's a question of like, okay, why would I do bonds over cash if my cash equivalent in something like a short-term treasury bill or a money market fund is getting me pretty similar return? You do generally, theoretically, get a higher return on bonds than you would with cash equivalents in the long term, but there's a little bit more risk involved, especially with using like funds compared to like specific treasury bonds because of how interest rate fluctuations tend to go. That being said, I wouldn't... There's other diversification options out there, but bonds are typically like your main diversification source if you're really heavy on stocks. When you're young and have a very long time horizon inside of something like a retirement account where you know you're not going to be selling anything, then you're not as worried about like market timing. Whereas like if you're approaching retirement or purchasing something or you need your money at some point, then the timing of stocks gets tricky. Sometimes you don't have time for it to recover for a decade, so having a larger portion in bonds, which are a lot steadier, can help. And if you're looking at just like risk adjusted returns instead of absolute returns, which for something like a big like pension fund sometimes is like a much bigger consideration, then bonds like a lot of times make portfolios look prettier on paper. That's one thing I do kind of want to touch on. So one of the reasons like companies love bonds so much. So if you just look at bonds on paper, you're like, okay, this return sucks. Like, why am I using this? A lot of times with bonds, like, you can have bonds that you're like borrowing money by producing your own bonds. Then you're putting that money towards something else to get even higher returns, meaning you're increasing risk. But one thing you'll see like a hedge fund do is like sometimes they will borrow money, sometimes in the form of bonds, sometimes like a bank loan, but they'll take that and then they'll buy other bonds that are like mispriced according to like their computer systems, and they'll try and like increase returns that way. So if you think bonds are relatively safe and then you double the risk involved on them by leveraging a return where it's like you're borrowing at 3 or 4% and then you're increasing your 5% return into like an 8 or 9% return, all of a sudden you now have strategies that can kind of compete with like stocks. And if you're in like a private or public company, like if you're borrowing money as a company and you're doing that and you're able to produce, 15, 20% returns, then you really start to see why like bonds are super helpful at like a big size level. But like as far as like retail individual investors, like most people don't make use of leverage that way. They use like a mortgage. It's just kind of how it goes, because a lot of times when you get leverage through bonds as like a fund, you end up paying a lot higher fees involved, and the fees end up being such a drag on returns that it ends up not being as worth it as much, like mathematically, for how much risk. Like the risk adjusted return like isn't as good as just like maybe like stocks or something. This can be frustrating to reality, but then it's like there's this curve that happens, like the normal curve where you see a little picture where the guy's like, bonds are great, and then in the middle is the guy who's like, bonds are awful, and then he comes right back around to like, no, bonds are great. It's just like knowing where they fit is such a big difference. So let's take a look at some of these other questions as well. One basic term I think I didn't cover as well, like when it matures, like that's when like the expiration date of the contract is and you get your money back. Let's see. How does the yield curve impact investment decisions? So the yield curve is on U.S. government bonds from the federal government. There is ranging from 30 days up through, I think it's 30 years, that the Federal Reserve really tries to manage, but there's only so much they can do. A lot of it is just by the market itself. With that happening, it will bend and change depending on like supply and demand, as well as things that the banks try to do and the Federal Reserve tries to do to like manipulate it. Not banks as much, but anyway. Money supply is changing, yield curve is changing. It shows like what the interest rate on those particular federal government reserve bonds, not reserve, federal government bonds are. With that, a lot of like economic indicators, when the yield curve bends like this, meaning it's technically like inverted, like the short-term rates and the long-term rates are both down, but the middle isn't, like that's not a good sign. That usually means the economy's not doing well. A lot of decisions around is the economy doing well or is the economy doing poorly is based off of the yield curve, which is the federal government bonds. What shape is it? Generally, it's supposed to just be like a line. Long-term bonds are supposed to pay a higher rate than short-term bonds because holding them for longer means more risk. That's just part of it. And there's like tons of theories that explain like why that price is baked in, but that's generally what has been the case. So there are different types of bonds. So one that exists is something called a callable bond. So frequently this will have like a higher interest rate, and it means that a company will put out like a 10-year bond, and every year or every couple years will have the ability to recall that bond, give you your money back, and stop paying you interest. This is to protect the company if interest rates were to change. Meaning if interest rates go down, they don't want to be paying you that high of an interest rate anymore. So usually they have to pay you a higher rate to begin with in order to get access to that. Another type of bond, convertible bonds. So you have just a standard bond. Usually this pays less of an interest rate than typical because there is a clause in there that at certain points you have the ability to change it into a certain amount of shares in the company, meaning equity ownership. Again, these things aren't as common, but they are still fairly common. There's all sorts of like funky bonds out there, but we don't need to cover them all. I think the other big one is zero coupon bonds. That's basically when a bond has no more interest payments left. A lot of short-term bonds end up like that, and then they're discounted to make up for it because there's no more interest. It's like the interest rate is cooked into the price. It's kind of hard to explain without a chart, but that's just kind of the basics of it. What are negative interest rate bonds and why do they exist? It's kind of... Yeah, let's not get into that mess. That happened to Japan and it was just messy. How does reinvestment risk affect bondholders? So when a bond matures and you get your money back, you need somewhere to put your money. A lot of times this creates something called reinvestment risk. So where this money could typically go is usually just back into bonds. So one thing that you can do is something called like a laddered treasury like strategy. So like you have 3 months, 6 months, 9 months, 12 months, and you're getting better interest rates, your cash is coming up, but a lot of times when that happens, your 3 months like matures, you'd want to stick it to the back to the 12 months. But the problem is like, okay, what's happened to the interest rate of 12-month treasuries? This is even more important with like very long-term ones. Like if you have $1 million of 10-year treasury bonds and they finally mature, well, if they used to pay 8%, now you can only get 4%, all of a sudden your annual returns for your portfolio are significantly lower than they were before. This is part of the concern with bonds and interest rates and why the treasury yield curve kind of like moves around and such. How do investors use bonds for diversification? Basically, when you're getting a steady income from the bonds, the value of them can fluctuate with interest rates, but it doesn't move around as much as stocks typically tend to do, and they tend to move around at different times than stocks. At least theoretically, it doesn't work as well as it necessarily used to. Explained a ladder. So then there's the conversation of individual bonds versus bond funds. So bond funds are typically what people do because buying individual bonds is a pain in the butt. If you buy individual bonds and they're not like the federal government, there is the risk of a particular company going under, which is just an unnecessary risk most of the time. Not to mention you do have to have like the correct amount to fit in there in multiples of 1,000 or 100,000 or however large. Typically that's much more for institutions or quite wealthy clients than it is for like individuals, except for treasury bills. Treasury bills are a little different because there's so many of them. In terms of like pros and cons of them though, individual bonds, inconvenient, but you have a lot more control over, even if interest rates like go up and down, you're still getting your income, you're still going to get the maturity date, like your money back. So you aren't technically affected by any sort of market fluctuations as long as you're planning on holding it to maturity. That is a very powerful effect if you buy them at the right time. So if interest rates for everything are high and you lock in treasuries at say 6 or 7% for 30 years, well, if in 10 years interest rates are 4%, you're pretty happy. Now with a fund, that's sometimes they do that themselves, meaning they are professionally managed, but you tend to be just open to interest rate fluctuations in general, but they're more convenient, much more convenient, and there's much more the diversification. I keep accidentally answering some of these questions. So one thing we could cover is like as you're aging, typically the advice is like you're moving more from stocks into things that aren't as risky, like you're purchasing your home, you're putting your money into more bonds, you're putting it into things like, well, usually not cash, but sometimes you might hold like collectibles or gold or something like that. And the question is like, okay, at what point do you start putting more into bonds? And how much? And like there isn't just like one general blanket advice for all of this because some people in retirement like their assets are so large relative to their expenses that like even though they're old, their risk tolerance or risk capacity is like significantly higher than a normal person because they could live off their bonds or cash for 30 years. So it kind of depends. Now if you were to take just like a normal person, average middle income, they save like 10-20% in their 401k throughout their entire career. Generally speaking, sometime around like 45 to 50, you're going to start shifting a lot more into bonds as far as how much you're putting in, while your stocks are doing more, and occasionally you're rebalancing into your bonds a little bit until once you hit retirement around age 65 or 67 or whatever they're changing it to now as people get older. At that point, typically you're looking at getting towards like 60-40, like 60% stock, 40% bond. Maybe you get down to 50-50, and then as you get more like 70, 75, just kind of every few years click down a few percent until all of a sudden it's like you're significantly more bond than stock and you're just living off of income. But I do think if you do have the ability, having more than just stocks and bonds typically is a little bit safer just in terms of diversification, but it really depends like where it's coming from. Like asset classes tend to perform the same, but the thing with like retail investors is like how they acquire said assets like individually versus funds like does tend to affect how they perform and how you can sell them down the road. So something to keep in mind. Main risks involved. So there's interest rate risk, there's the reinvestment risk. Those are honestly the big ones. I mean, obviously, like a company can collapse with like a junk bond or something, so there's that as well. How do bonds tend to do during economic recessions, and like how does that work? It, it all depends on what interest rates do. So if there's an economic recession and then government spending to offset the recession, similar to like what happened in 2021, then this hasn't happened every time, but this is generally like the soft science of what should quote unquote happen. Inflation will happen because they projected a bunch of money into the economy. When inflation goes up, then the Federal Reserve, if it's too extreme, will start injecting interest rates to go higher. Usually they're constricting the money supply. And then this is when bonds can do poorly, even from an economic downturn. Now, if there isn't government intervention, they're just steady throughout the whole thing. And frequently they actually even do a little bit better because demand for bonds goes up, so the price goes up. But yeah, it really depends on how heavy the government intervention is. And there's also other times where like there's not that much of a recession, so there's almost no government intervention, and then it's not as much of an issue. We also had like 20 years of like close to no inflation, so it really depends. It's a lot of correlation, not causation, except for, I guess, direct government intervention can be causation. But generally speaking, expecting it to be 100% one way is not how it's always going to go. How to consider, like, geopolitical risk when it comes to, like, bond investing. You can invest in, like, higher risk countries, and that used to be, like, a big way to, like, you would take that, leverage up, and then increase returns that way, and it would be like outsized returns where your money's locked up for longer periods. It can be helpful, but like then there's times like right now where there's like wars that happen, and that can be a concern. Generally speaking, when you're looking for risky things as like a normal person. It's just unnecessary. There's so many things that do well otherwise that you can. It's just a lot to consider. What is liquidity risk in bond investing? So that's one thing that for most bonds in the United States is not almost ever an issue outside of maybe municipal bonds in a very specific location. It's a very small issue. Now, in other countries, like if I get a bond from Lithuania or something, maybe they only issued, 1,000 bonds. Well, I'm going to have a hard time finding someone else who wants to buy that bond. Then you have liquidity risk. Usually, you're going to be paid a higher interest rate for having to sit on that bond for so long, but it does cause issues, and it's usually for the more like exotic type options, but still important. Let's see. How exactly does like the central bank manipulate the bond market? So the main thing they have more than one thing they do, but the main thing, they buy bonds and they sell bonds. So they can increase or decrease the money supply depending on how many bonds are out there. So if they buy bonds, meaning they take the bonds from the bank and give the bank money. There's now more money in the economy. The bank lends it out to more and more people. Then all of a sudden there's more money out there. Whereas when the government wants to lower it, then they sell bonds, they get money in, all of a sudden less supply of money. Economy slows down, interest rates go up, yada yada. They can set like target rates and things like that, but manipulating of the bonds tends to be the big thing. So one other thing you'll sometimes see is like options contracts on bonds. These are a lot more common on stocks, but you can see options on them because options, you can basically get an option as like just some sort of betting agreement on pretty much anything in existence at this point. They've gotten like crazy with the level of detail they can go into. Basically, you want to bet on interest rates going one way on a company, or you want to bet on a certain country, or like you can send it in pretty much any direction, but there is fees involved, and the more you leverage up, the more risk there is. But if you have a strong inclination, or you have like insider information or something, which plenty of people have used, I do not recommend, but there are ways to basically like get outsized returns if you have some information advantage. What should investors consider when selecting bonds in rising or falling interest rate environments? I tend to think very long term, go as far out as you can relative to your horizon, meaning like try to plan correctly around it. So I wouldn't really try and market time too much with bonds other than just don't have the worst possible timing ever, but that's how I feel about pretty much every asset class. That's pretty much all the questions. I mean, there's a lot of stuff that can get complicated, but there's not usually a need to go mega in depth on all of that. I'm going to be covering some of the other asset classes as I do some more of these live streams, and I'll probably spend some time figuring out how to kind of go a little longer with this. But my voice is completely dead right now, so I'm going to hop off. Thank you guys for watching. Bye.